Hi students. Well, this is our last video on leasing, and it's going to be a short one because accounting for the manufacturer, dealer, or sales type lease is very, very similar to accounting for a financing type lease for the lessor. There are very few differences. So we're just going to do a brief example here and really focus on the differences between the two. So you'll note that the entries are really the same, except that the dealer is not going like outside to a supplier and buying the goods or the equipment to lease it to the lessee. Instead, it is part of their inventory. They own it already, and they're going to make a profit when they sell it. And even though we're not really selling it, we still treat it mostly as a sale. So the idea is, if you're leasing it and the lessee is going to use up all or most of the value of that item, then you really in a way have sold it. So we're going to call that a sale. And as you know, when we sell things, we have a journal entry to cost of goods sold. So that's going to be one of the differences here. So we're going to take the same data that we just used in the previous video, so same lease amortization schedule and everything, except that it is a sales type lease. So the market value of this is $100,000, and that's a sale. The cost to the dealer is $85,000. So we can see that there's a profit here. So let's look at how we account for that. So the very first thing, notice that there is no account called equipment acquired for lessee. You didn't do that, so don't put it in. However, you do have a lease receivable, which is the exact same amount of money because it's the same lease. So our lease receivable is still $119,908. Our unearned interest income is the same, but this time it's our sale. That's $100,000. And as you know, in a perpetual inventory system, we're going to debit cost of goods sold and credit inventory. So that's almost the only difference. Now, when we go to get our first payment, I'm just going to move this over here. Notice that this is our cash debit, our lease receivable credit, and our maintenance and repair expense credit. So this is the same set of journal entries that we used for a financing type lease in the previous example. So notice that this is not different because the essence or the underlying concept of the lease is the same. It's just that the dealer earned a $15,000 profit off the top. So this is January 1, 2017. Here is the end of the year, accruing our interest income. And then the next January, the next day, same thing. There is a repeat of that entry. And then on December 31, we're going to do our journal entry to accrue our interest revenue. So I think you'll notice that generally speaking, this accounting for the lessor is not as complicated as accounting for the lessee, and a lot of that has to do with the fact that you don't have to calculate depreciation. All you're doing is accruing interest revenue and taking your money. So really not a whole lot to do there. But anyway, that concludes our section of videos on leasing.